Just getting up a list of content that we cover every week, but I just want to just list it out. In the context of our global markets forecast, we look at the S&P 500, the DAX, the FTSE, the Shanghai Composite, the Australian market. We quantify the strongest economic sectors in the United States and Asia Pacific, namely Australia. We look at gold, the Australian dollar, metals and mining, energies, robo opportunities or robo stocks, and other investment opportunities. So let's get started this evening and start by just a very brief discussion of the fundamentals driving the market, and then get into the technical justification for points of view that you may or may not have. So the four primary macroeconomic global fundamentals which are driving this particular market are Brexit, China, North Korea, and the story that's trotted out on a regular basis, the inverted yield curve, which Alan's put in a comment I'll read out in a moment. So just going through each point, Brexit is chaotic, but I don't believe it is of any consequence because, as I mentioned, the UK stocks are so undervalued, irrelevant, it's irrespective of what happens. Fund managers are coming in and rebalancing their portfolios basis the UK and also German stocks or European stocks. China is an ongoing negotiation. The fact that they're negotiating, it's a positive. North Korea, mentioned it many times, it's a fading issue where the North Koreans really do have to come to the party if they want to join the global community. And the yield curve inversion story, which this is the second time we've heard this year. I'll just read out Alan's comments because it's in context. Alan, this is New Zealand, Alan says that just reading that every time in the last 50 years when the 3-month bond yield moves ahead of the 10-year yield, it has been followed by a recession. Not a good sign right now. I don't agree with you, Alan, and because it's a story which is fear-based, which has no technical evidence to support, and the actual fact is that it is a true statement that recessions do follow the inversion of the yield, but the stats tell us 14 to 17 months. So is it not a good sign right now? No, it's got nothing to do with the current market, and it's like saying that the inversion of the yield is going to crash the market tomorrow, which is a ridiculous statement to make. It's not, and there's no technical evidence to say this market is anything but a very, very strong bull market, and it's going up until proven otherwise. That's proper analysis. That is investing in what you're looking at, not what you're thinking, and I must have said that 1 billion times. That overthinking and using pieces of information to justify a future forecast, which may or may not be valid, can be very damaging to your decisions that are being made in the present. So let's start by looking at the S&P 500, or I'll do something slightly different. I'm going to start with the mid-cap index, the IWM. The reason I want to start with IWM, I'll come back to the S&P 500, is that I made some comments last week that I didn't know whether it was going to do a 3-wave structure or break up, and I think it is absolutely clear what it's done. Market's fallen, broken trend, market's gone up, and it's done a 3-wave structure. Now, if I start putting a few other lines on this screen, you should start to see that if this market starts to move up from about this point, technically speaking, what have we got on screen? What's happening on screen? Is it a breakdown, or is it probably the construction of the right-hand shoulder of what is an inverted head and shoulders pattern? I can't answer that definitively this evening, but I would suggest the next move is probably up in equity markets, and if the market does continue up by next week and starts to break above the previous swing high, we have got ourselves a completed right shoulder on the IWM, and therefore that's really bullish. There's nothing bearish about that chart. There's no significant breakdown. It's just every time the market goes down for a couple of days, the psychology flicks to the negative, which is completely, in my view, not correct. Let's come over to the S&P 500 and see if there's a similar story looking at the broader index. Just a small delay on the pickup. In fact, I just might reduce some of the resources I'm chewing up in the background. Okay, looking at the S&P 500, we know the broader picture. It's in absolutely a strong bull market and has been going up for a considerable period of time since 2009. And the recent lows in December is essentially a reversion back to a trend line which has been well established. And in the last few days, what have we seen? We've seen a bit of a pullback, which is nothing unusual because this market also, most likely, is building its right shoulder. And I'm just going to put in a trend line basis the previous lows on the left shoulder of this inverted head and shoulders pattern, and there is potential for this market to continue on down. That said, if it does not, which I believe it's not going to do that, if it does not, if this market breaks up from this point, which I believe that it's about to, it's what I think is about to happen, this is extremely bullish because what does it mean? It means the market's accelerating. The pullback is just inside the previous swing high. If it pulls back to that trend line, the momentum is not as strong. So there is a bit of evidence if we go through and look at individual sector charts that demonstrates that the most likely move is a breakout. In fact, there's many markets that started to break into new highs as of last night, while the market, that is the index, was moving to the downside. While these shoulders are being built, these technical shoulders, volume can look negative. In fact, if I look at the advancing and declining numbers from last week, we had, within the S&P 500, we had 261 advancing shares and 212 declining. This week, we've got 247 advancing and 226 declining. And as I've stated many times, the volume of those numbers is the key. The declining shares within the S&P 500 are in volume terms 1% above the advancing stocks. Is that significant? No, 1%, you can call it even. So it's not unusual when a market has a small pullback that these volume figures shift slightly less bullish than they were the previous week. And that is a true statement because last week the advancing volume was 26 above declining. This week it's slightly gone negative. What would be a warning signal is if this market, as it breaks up again, the volume doesn't dominate on the advancing stocks. That would be a warning signal. If there was a divergence in upward moving markets, declining advancing stocks and declining volume on those advancing stocks, okay, that's a negative picture, but that's not what we're observing in the context of the advancing and just the breadth, it's called, the breadth of the market is still stable. Coming across to trading volumes within the market, looking at the S&P 500, the trading volumes, that is the institutional volume behavior, has backed off since last week. But again, I just repeat, that's not unusual because we've had a pullback. We're in a pullback. So once again, the negative to me would be, as the market has its next move to the upside, that volume doesn't kick in to drive it. That would be my expectation. Or if, technically speaking, by just looking at price, the price chart starts to break down and breaks the previous swing low, which was earlier this month. That would be a very negative signal. So at this point, when I look at the two indices, S&P 500 and IWM, there is absolutely no evidence to suggest that these markets are doing anything but consolidating their neckline and potentially, because it hasn't happened, getting prepared to do a break to the upside, and that would be following what happened exactly last year, if it does occur. Last year, as a reminder, from March to October, we had an extremely strong expansion. Just give me one moment, I need a drink. Extremely strong expansion, and we continued on to the right through to October, avoiding all this go away in May fairy tale. So at this point, we've got an strongly upward trending market, which is potentially having a shallow pullback, which is showing absolutely zero signs of breakdown at this point in time. To support this view, we need to look at the VIX, because there is a warning signal potentially on the VIX. I'll do that last of all, after I've reviewed all the indices, because we know the VIX is the fear index, and there is some little signs of something potentially happening, but it's just way too early. It's another thing that tells me that this is unlikely to be a top, because it's not supported by the fear that's generated by the VIX that we mapped out in absolute detail in September 2018 and January 2018. If you recall those two analytical periods where we mapped out a top via fear and basically nailed exactly what was happening. So that doesn't exist. It's a pretty important component. If there's no fear, there's no hedging. If there's no hedging, you've got to ask yourself why there's no hedging, because institutional investors don't expect any form of a top anytime soon. Let's come down and have a look at other markets which support an ongoing bullish global environment, because that's what we want. We want a synchronized global environment, which is something that didn't occur a few months ago, but is absolutely in play at the moment. For example, EWG, first of all, the exchange traded fund relating to Germany, has been, as we know, tracking sideways, forming a right shoulder on an inverted head and shoulders pattern, and as it continues to track sideways, it is simply confirming what is a low as it breaks trend, and every time, to maintain this trend, it needs to break into a new high. Recently, that is exactly what it did. The last push broke into a new high, broke above the neckline. That is not bearish, that is bullish from a technical perspective. So as long as it keeps on going, it's all good. It could even break down a little bit, but at the moment, it looks absolutely fine. Coming across to the DAX, the actual DAX index in Germany, looking at the actual DAX chart, it's the same story with an evolving picture, which is forming a trend to the upside, which recently has had a break into a new high. So there's nothing at this point negative, what I can see technically speaking, in the two pictures or the two charts that represent the European markets. Let's come down to the closest or most important contracts as far as I'm concerned, which is the Chinese. And we look at them through two indices. One's traded on NYSE, that's FXI, representing, I think, 25 large cap stocks made into an ETF indice. And we can see the broader picture on this. I haven't been keeping up with the pictures, but the recent move to the upside, what did it do? It broke into a new high, has pulled back. A little bit volatile, but what's it doing? It's simply forming a trend within the context of an accumulation phase, which is tracking sideways. Absolutely nothing other than bullishness demonstrated on this screen. Coming down to the Shanghai Composite, which had been going absolutely ballistic, driven again by the expectation of a deal and a compromise done with the United States, which is still in progress. Again, massive moves to the upside when progression had been made on that deal early in February. A bit of consolidation at the moment. There's no major breakdown. I think they had some small problem reported in the news yesterday, but at this point, as we sit here today, it is still quite bullish, and there's nothing negative about the picture that I'm looking at. When I look at all the volume pictures, that is the trading, institutional trading volume, it has gone negative from last week. But once again, I repeat, it can't be super bullish when you've got a market having a pullback. I would expect if this market starts to move up again in the next 2 weeks, you'll see positive institutional volume behaviour kick in, and that's what's driving the market up. So that's my expectation. If that doesn't happen, I'll be singing a different tune, but I can only analyse the market in real time, as you know. I can't see into the future. At this point, it's all remaining a bullish picture. Coming down to Asia Pacific, in particular Australia, looking first of all at, I have actually gone a bit too quick. I wanted to actually review the European market in the context of EWU. Apologies. Brexit, very topical story, and if the chaos caused by Brexit is such a negative for the UK markets, explain to me why is the UK market dramatically tracking to the upside. I've already explained it to you. The fact is that's a confirmed accumulation pattern which is has formed a low, has broken trend, is maintaining a trend based on 20-period exponential moving average. It's extremely bullish, and therefore all the charts that we've looked at so far for the first time, and this has only just happened since February, because prior to February we didn't have a synchronized global market. That's the big switch that's happened since earlier this year, 2019. We now have global synchronization. China was going down. The UK was going down. Europe was going down. They've all switched in the last 2 months. This is very, very bullish for global equities, not bearish. Therefore, there is absolutely zero reason to hold a bearish stance at this point in time. Coming across to Australia, looking at EWA first of all. EWA, that we all know is the exchange traded fund traded on NYSE, representing Australia, dominated by financials and mining, and it has been tracking sideways with a little bit of a breakdown. I've described that sideways move as a time correction rather than a price correction. Price correction being a pullback, time correction just being a sideways move, allowing the average rate of change of price to catch up as defined by the 20-period exponential moving average. And the next move on that should be a decent break to the upside. Hasn't occurred. We'll see how that unfolds in the next week. Coming across to XJO, which is the ASX 200 within Australia, the national index representing our local markets, we can see a picture of bullishness. The market has gone up, rejected at 0.618. We've looked at this in the long, big picture. I'll just do it very quickly. Coming over to the monthly chart, we're well aware this market has been tracking up very, very strongly since 2009. That trend is maintained. Are we in a bull or a bear market? We're in a strong bull market, and we're looking for confirmation and continuation of the charts. At the moment, what's it done in the last week after hitting and rejecting at 0.618? It's done what? That's what I wasn't sure of last week. I didn't know whether it was going to do a three-wave structure or not. It's done a three-wave structure. It's come down and it's done actually everything to confirm that it's going up again. So for technically a three-wave structure without, in-depth explanation, it's simply in a bullish environment. It's actually a very bullish signal. Market needs to come down, market needs to go up, and needs to fall. And the trigger, if you were trading this, the trigger to buy was a crossing of that low here. It's already covered it. We've seen a massive shift in sentiment today with a very large bar to the upside, up 0.65. It's extremely bullish. The only thing I would say about extremely bullish one-day moves is that they tend to be followed by consolidation, sometimes an inside day. The only way this will drive hard tomorrow is if we start to get this move up in the US. Just give me one moment. Okay, I'm good. So looking at this particular chart, it's absolutely bullish. We can come down to individual charts which are driving each sector within this market, And we can see also an extreme picture of bullishness. There's absolutely no negativity within this market that I can see other than a pullback, which we've just experienced. In fact, before we get into quantifying sector strength, let's just go have a look at a couple of individual charts. And don't let me forget, I haven't done the VIX analysis. So I'm just going to jump across and I'll just have a look at the US charts to start with.